I'm Mira.
So we are recording this on Sunday evening, August 23, 2026. And really, the mission of this deep dive is to establish the macro backdrop entering the new week.
Right, because there's just a massive web of variables right now.
Yeah, exactly. We are going to make sense of a truly complex weekend of news, and set the baseline you are operating against.
Between trade negotiations completely collapsing and, well, the geopolitical chessboard shifting so dramatically over the last 48 hours, we really need to connect the dots so you have the full context.
We do, but before we jump into the first session, I need to explicitly state that this show is for market context and discussion only. It is not personal investment advice or, an investment recommendation.
Okay, with that out of the way, how do we want to frame this?
Well, let's just take it one step at a time, starting with the reality of the tape. Which brings us to our first major question. Session 1. How did the markets actually move this past week?
Right. So if you look at the broad slide from the mid-August peaks, it was a decidedly risk-off week. Like, the market wasn't just taking a breather, it was actively retreating.
It really was.
Yeah. So to set our baseline, let's pull up the specific Friday, August 21 closing numbers. The S&P 500 dropped 1.43% for the week, closing at 7,674.37.
Wow.
And the NASDAQ, it took a noticeably harder hit, falling 2.05% to end the week at 26,180.46.
And, when you see tech underperforming the broader index by that much, you typically expect to see a spike in volatility, right?
Well, absolutely, we did. The VIX, which, is the market's primary fear gauge, it spiked up to 16.01.
Right.
Now, 16 isn't outright panic, but it is a pretty sharp wake-up call from the complacency we saw earlier in the month.
For sure. But, the real driver here isn't happening in the equities market at all. It's happening in the bond market.
Yeah, the yields.
Exactly. The 10-year Treasury yield closed, elevated at 4.738%. We talk a lot about discount rate gravity compressing equity multiples, and I don't want to overcomplicate it, but
it's essentially a gravitational pull.
Right. Think of a 4.7% risk-free rate, like this heavy gravitational pull on high-flying stocks. When investors can get almost 5% guaranteed from the U.S. government, the math on future tech earnings suddenly looks much less attractive. It just pulls those valuations straight down to earth.
Yeah, that mechanism explains the NASDAQ's outsized drop perfectly. And interestingly, while yields were rising, the U.S. dollar actually weakened, closing down at 98.84. But Daniel, the most startling price action was happening in the commodity sector.
Which is usually where the market goes to hide when it's scared.
Precisely. We saw a historic surge in gold this past week. It settled at an incredible $4,662.20 an ounce.
That is massive.
It is. And at the same time, WTI crude oil climbed to $86.71. That crude spike is directly tied to the geopolitical supply fears we're going to discuss in a moment.
Wait, let me pause you there because I really want to challenge the reflex I'm seeing from a lot of commentators right now.
What do you mean?
Well, people are treating this equity slide like it's a random sentiment-driven sell-off. But when you look at gold crossing $4,600 and oil pushing toward $90 while the 10-year yield sits above 4.7%, that isn't a sentiment issue.
It's structural.
Exactly. That is a structural repricing of risk. The market is pricing in inflation that just won't die and geopolitical risks that are multiplying.
Yeah, you're pointing to a fundamental shift in the macro landscape. So to briefly summarize this past week, the market was defined by high yields acting as an anchor on equities, while massive commodity spikes telegraphed severe global uncertainty.
Perfect. That sets our baseline. We're going to signal a short break right here, but don't go anywhere. When we come back, we're going to look at the weekend headlines that are setting up tomorrow's open.
Welcome back. Now that we understand the pressure the market was already under on Friday, we need to look at what happened while the markets were closed. Session 2. What were the key news events over the weekend and what are their market implications?
Right. So looking back at Friday's Watch Next section, we noted two major things to keep an eye on: the U.S.-Iran maritime blockade and the ongoing AI capex repricing.
Both of which absolutely dominated the weekend.
They did. But we also got hit with a massive trade shock that just wasn't fully priced in.
Yeah, and that trade shock is arguably the most immediate headwind for industrial earnings. On Friday evening, the U.S. Canada trade talks completely collapsed.
Totally fell apart.
Yeah. U.S. Trade Representative Greer and Canadian Prime Minister Mark Carney failed to reach an agreement, and the diplomatic fallout was instant.
The U.S. utilized Section 338 of the Tariff Act to impose aggressive 50% tariffs on Canadian vehicles, dairy, and cement.
And in response, Canada suspended all further talks. They announced a dollar-for-dollar retaliation specifically targeting U.S. steel and dairy, which kicks off on September 8th.
Right, which completely upends the narrative the market had on Friday morning. Because we've talked about the difference between quotas as absolute volume caps over tariffs. A quota is just a speed limit, you know? Prices stay somewhat predictable.
But this is a tariff.
Exactly. What we just got is a massive tariff acting as a chaotic, unpredictable toll booth.
Right. It instantly creates supply chain shocks as a multi-channel margin tax. I mean, if you are a U.S. manufacturer relying on Canadian cement, your costs just skyrocketed overnight.
And this margin tax hits at a terrible time because we are navigating a two-speed economy.
Yeah, the services PMI just came in at an accelerated 56.8.
Right. The service sector is still running hot, but manufacturing has eased down to 53.2. So this trade war targets the manufacturing side, threatening to drag it down even further, which, creates a massive dilemma for a divided Fed.
Yeah, the economic fragility is one thing, but it's colliding directly with severe geopolitical stress. Over the weekend, CNTCOM enforced a strict blockade in the Strait of Hormuz.
Which escalated quickly.
It did. They diverted 68 commercial ships and actually had to disable 3 vessels to ensure compliance. Iran immediately countered, threatening to target the assets of any nations assisting what they're calling U.S. economic warfare.
It is incredibly tense. But look, I have to challenge the way the market tends to react to this. There's this reflex to treat geopolitical events in the Middle East like unpredictable natural disasters. We really need to look at this through a game theoretic lens.
Okay, walk me through that. Why shouldn't the market panic over 68 diverted ships?
Because what we are witnessing is geopolitical escalation as game theory brinkmanship. The escalation is calculated. Yes, the blockade is severe, but look at the back channel movements.
Like the talks in Jordan.
Exactly. We had reports on Sunday of secret security talks between Syria and Israel in Jordan, mediated by the U.S. That is proof of calculated de-escalation efforts happening in the shadows. Both sides are pushing right to the edge to maximize leverage, but nobody actually wants to go over the cliff. It's managed chaos, not blind chaos.
That's a fair distinction, but managed chaos still carries a massive risk premium, which, brings us back to why oil is at $86 and gold is at $4,662. And let's not forget Eastern Europe.
Right, Zelensky's announcement.
Yeah, over the weekend, Ukrainian President Zelensky revealed a staggering $27 billion funding shortfall for their defense ministry. So you have prolonged stress in Europe layering on top of brinkmanship in the Middle East.
Which naturally pivots us to the other massive story dominating the weekend. Because while the physical supply chains are under attack, the digital supply chains are facing their own crisis. Let's talk about tech and AI capital expenditures. Nvidia just dropped a bombshell on its clients.
They certainly did. Nvidia formally notified clients of price hikes exceeding 15% on their next-generation Vera Rubin and Grace Blackwell systems, slated to ship in early 2027.
And this price hike is happening at the exact moment Broadcom is reportedly seeking over $60 billion in AI debt financing.
Yeah, this is the danger of AI capex as a self-referential valuation loop. You have the hyperscalers committing billions to build out data centers, and now the hardware makers are raising the toll by 15%. If the cost of building the infrastructure skyrockets, the hyperscalers have to monetize their AI products that much faster just to break even on the debt.
Okay, wait, let me play devil's advocate here for a second.
Go for it.
Is it possible this narrative of a capex crisis is getting a little too neat? I mean, are we sure these hardware price hikes aren't already priced into the market? Because while public equities are sweating over these bills, look at what happened in the private markets over the weekend. Hugging Face is fielding M&A interest, valuing them at $13 billion.
Right. The private market is still hot.
Exactly. If private market confidence in AI is still that robust, are the public market fears of a capex collapse just irrelevant over a longer time horizon?
It's the ultimate tug of war. The private markets have the luxury of patience. The public markets do not. If the hyperscalers can't generate the cash flow to cover these 15% price hikes in the next 2 quarters, the public equity markets will punish them.
Regardless of what venture capitalists think. All right, so to summarize the weekend's theme, we have escalating trade costs from the Canada tariffs, spiking capex costs from Nvidia, and geopolitical brinkmanship in the Middle East, all colliding violently with a fragile macro baseline. We're going to signal a quick pause right here, and when we return, we will transition directly into what specific economic data will prove or disprove these fears in the coming days.
Welcome back. We've seen the weekend headlines, so now we need to look at the calendar. Session 3, what should we be watching in the coming week?
We have a very specific set of catalysts on deck. Let's walk through them chronologically, keeping all these weekend shocks in mind. Mira, what are we looking at for Tuesday?
Tuesday kicks off at 10 a.m. Eastern Time with the Conference Board's August Consumer Confidence Report. But the real test comes at 1 p.m. Eastern Time when the Treasury is auctioning $69 billion in two-year notes.
Yeah, and that two-year option is critical because it tracks closely with Fed policy expectations. Moving to Wednesday, the schedule is incredibly dense. At 8:30 a.m. Eastern Time, we get the July PCE and core PCE.
And for listeners who might usually watch the CPI, remember that the PCE is the Fed's preferred inflation gauge.
Right. Because alongside the PCE at 8:30 a.m., we also get personal income and spending data, the Q2 GDP second estimate, and July durable goods orders.
All hitting at once.
All at once.
Yeah.
Then, at 10:30 a.m. Eastern Time, the EIA Weekly Petroleum Status Report drops. Given the 68 ships diverted from the Hormuz blockade over the weekend, the market is going to be hypersensitive to any drawdown in those petroleum reserves.
Absolutely. And then at 1 p.m. Eastern Time on Wednesday, there's a $70 billion five-year Treasury note auction.
Treasury supply just keeps coming.
It does. Because on Thursday at 8:30 a.m. Eastern Time, we have the standard weekly jobless claims. That is followed by a $44 billion seven-year Treasury note auction at 1 p.m. Eastern Time.
Look, let's just pause on that math for a second. Between Tuesday, Wednesday, and Thursday, the Treasury is asking the market to absorb $183 billion in new debt.
It's staggering.
It is. If buyers demand a higher yield to swallow that much supply, that 4.7% 10-year yield we talked about in Session 1 is going to push even higher, putting more pressure on the NASDAQ.
It's an avalanche of supply. And then Friday morning brings the fireworks. Between 9:45 and 10 a.m. Eastern Time, we get the Chicago PMI and the revised University of Michigan sentiment.
And I have to remind everyone of the bizarre dynamic we are currently in. If that consumer sentiment and PMI data comes in too hot, we are right back in the paradigm of good news as bad news for rate cuts.
Right. The market actually wants a slight cool down to justify the Fed lowering rates.
Exactly. And then the main event. At 10 a.m. Eastern Time on Friday, Fed Chair Kevin Warsh delivers his highly anticipated keynote address at the Jackson Hole Economic Symposium.
It's an absolute gauntlet of a week. Between the data drops and the bond auctions, it perfectly captures the investor anxiety right now.
It really does. You know, it's a stressful Sunday night reset when you're scanning the globe for a safe haven and realize even Canada is threatening dollar-for-dollar trade retaliation.
Right. At this rate, with Nvidia jacking up prices by 15% and tariffs hitting cross-border goods, the cheapest, most stable asset class going into Monday morning might just be the premium maple syrup sitting in your pantry.
Seriously. As you set your alarm tonight, just remember, the Middle East blockade is active, trade talks with our biggest neighbor are frozen, and your portfolio is holding its breath. Hopefully, the only explosive gap up tomorrow morning is coming from your espresso machine.
I think we're all going to need a double shot before the bell rings.